All right. Welcome to this week's webinar. I'm excited to get to work with and talk with each of you. I want to talk about something that's incredibly important. Incredibly important, not just to the real estate investor, but also to those that are considering getting into real estate. Because as all of us are in a position where we have to say what's better, what's best for me, and what's best for my family. And what that requires of you is to understand the options at your disposal. One of those being real estate. And so, what I want to do is communicate to you one of the very specific values within real estate that I think is very differentiated to any type of earned income or portfolio income. The types of returns that you might earn on a spectrum could be anything from low risk, low reward investments like savings accounts or mutual funds or bonds, all the way up to high risk, high reward things like, say, venture capital or even the stock market to a certain extent. So I want to give you some insight into one of the distinct values of real estate, and that is the real estate tax advantages. The tax advantages associated with investing in real estate because they are substantial. Okay, so in order to do this, I want to try and communicate how important this is. So I want you to think through your budget, your monthly budget, the things that you spend money on. What are the things that are the most expensive of your monthly budget? What do you spend the most money on? And so think through those things right now. One, you might think mortgage or your rent. You might think your kids. You might think your food or entertainment. The reality is it's not any of those. It's taxes. For every dollar that you make, you're usually paying between 35 and 40 cents on that dollar. So 35 to 40% of your money is going to taxes. And most people don't really understand and fully comprehend that. That 35 to 40% is going to be made up of property taxes, federal taxes, local, state income taxes. All of those different types of things make up about 35 to 40%. And this is a huge deal because if you can minimize the amount of taxes that you're paying, you get to keep more money in your pocket. And as Robert Kiyosaki says, it's not about the money that you make. It's about the money that you keep. It's not about the money that you make on your W-2 statement or your salary, top line. It's about the money that ends up in your pocket. Okay? So, for example, let's say that you make $100,000 a year. Well, assuming 40% taxes, you're only seeing 60% of that in your bank account. You're only seeing that. It's not going to hit your checking account until the taxes have been pulled out. And what that means is you're only seeing $60,000 of that. So practically, you're making the exact same amount of money as someone making $60,000 a year who doesn't pay any taxes on it, right? And there's a famous saying. I want to say it's in one of Robert Kiyosaki's books, but he quotes a circuit court judge that says there are two laws of taxes, one for the rich and one for the poor, and they're both legal. All right, so we need to know what the rules of the game are so that we can play them most effectively and use them to the advantage of our individual families and our communities. All right, so we've got to be informed. So I want to teach you about some of the very specific and distinct tax advantages available in real estate. Okay, but before we get started, I want you to know who I am. I'm Blake Choisnet. I'm a real estate investor and coach. I'm a professional investor. And I went from being a burnt out 9 to 5er to retiring at 32 after building a multi-million-dollar portfolio in 18 months. And now I split my time between building my portfolio and teaching other people how to get started. And so I want to teach you how to do it too. So one of the ways that I'm going to do that is right now teaching you some of the advantages of real estate as it relates to taxes. Okay, so the tax specific advantages. Because when I think about real estate investing, there are three main benefits that come to mind. There's short term, long term, and medium term. The short term is cash flow. All right, that's money in your pocket. The long term is appreciation or equity growth, both appreciation and someone else paying down your principal, right, paying into your savings account. The medium term is tax advantages. So I want to talk specifically about how those tax advantages can make your rental income tax free. So all the money that you can make from rentals are tax free. They can be tax free. Okay, so in order to illustrate this, I want to tell you a story. I recently played Monopoly with a buddy of mine. And that friend didn't understand the rules. He was new to playing Monopoly, or maybe hadn't played in a long time. And so he didn't know that you got $200 every time you passed go, right? And that helped fund buying properties so that when people land on your properties, they pay you, right? He didn't know that. Now, what we could have let him go the entire game, but of course we didn't. We told him the rules. But I couldn't help but thinking, what would have happened if we didn't? Well, what would have happened is he would have failed miserably. He wouldn't have had any money to do anything, right? So we told him, but if we didn't, he would have been screwed, right? And I walked away from that thinking about the rules of our game, right? There are specific rules that we have to follow. Those specific rules are dictated by the IRS. And if you know the rules, you're in a better position than if you don't know the rules. He who is best informed has the upper hand. And so what we want to do is understand what are the rules by the IRS with the goal of paying zero income tax legally. Because the IRS incentivizes people to do certain things. The way that they do that is either with a tax credit or a tax deduction. They give people money. And the things that they want to incentivize are things that will help the economy grow and will help the community that we're a part of as a country. And one of the things that they recognize is that the United States GDP, or the amount of money that we make as a country, is directly correlated with the real estate market, which makes sense. There's a lot of services, products, and labor that goes into the real estate market at large. And so one of the things they do is they provide these incentives, these tax advantages to people that buy homes and invest in real estate. And so we have to be able to know the rules in order to play by the game. Otherwise, we end up just passing go and not grabbing $200, right? They're free rules. We've just got to know them. Okay. So in order to illustrate this, in order to teach you some of these advantages, I want to walk through an example on a property, a very standard property like the ones that I buy and the ones I teach my students to buy. But before we do this, we've got to know a few different terms, okay? Some of them are simple, some of them might be new to you. So first, we've got to know what purchase price is. Purchase price is the amount that you're buying the property for. Not necessarily the amount that's coming out of your pocket, but the amount you're buying the property for. So if you buy a property for $100,000 and you put 20% down, there's only 20 grand coming out of your pocket, but the purchase price is $100,000. Okay, so that's one. Another is rehab or renovation costs. This is the amount of money that we use to fix things up, to put it in better shape. And then once we fix it up, it's going to have a new value, or ARV, after repair value. So this is what the market says it's worth when that property is in good shape. It's in good condition, okay? And then you've got rental income, which is pretty clear, the rent that's paid to you. The other thing that I think is helpful before we jump into this is debt service. Debt service is what we pay in order to get the debt, right? We want good debt predicated on assets like cash flow generating properties, right? So when we get that debt, we have a mortgage payment that's made up of principal and interest. That is the debt service that I'm talking about, okay? So those are terms we need to know. There's going to be a couple other ones that I want to bring up while we talk, but from here, we're in a good shape, all right? Ready? So let's go. I'm going to use my whiteboard, and I want to walk through what this would look like on a really standard property, okay? So let's just say that I have a property that is a 3-bed, 2-bath. So let's just start with that. The property specs, it's a 3-bed, 2-bath, and let's say it's a 1,424 square foot home. Okay? Now, we're going to buy this. We're going to employ the BRRRR method. Okay, so we're going to buy it. The purchase price, as we mentioned, is 40 grand. Okay? But it needs $25,000 of loving. Okay? So we put $25,000 into it. Maybe that's a new roof. Maybe it's new flooring. Maybe it's lipstick on the outside so that it looks really good. Maybe some paint inside as well. And some appliances. All right? And now that we've done that, the new value of that house is worth $100,000. Okay? Now, these aren't numbers that we can make up. The purchase price is pretty stagnant. The rehab cost is going to be told to us by the market because this house is going to be worth a certain amount if it's in good shape. There's no way that we could force the value of this house to $300,000. The market will dictate that to us, right? And it's going to take $25,000 to get this to worth $100,000, to be worth $100,000. So once we get that, we take this money out as a loan, standard BRRRR. And if you're unfamiliar with the BRRRR process, go watch one of my videos that I've done on how to buy a house with $0, because we're going to borrow this $65,000. We're going to fix it up. Now it's going to be worth 100, and we're going to refinance our note. Okay, so we're going to leave 20% in, and we're going to take a loan out for $80,000. Okay, and let's just say that the rate is 5%. All right, let's do that. Okay, so these are the terms. All right, and we're going to be able to rent this thing for $1,200 a month. All right, this isn't characteristic of properties in every single market, but there are between 100 and 120 cash flow markets where this is very, very possible. So if you live in an expensive market, like say Dallas or New York or Nashville, and you're saying there's no way I could buy a house for $40,000 or it'd be worth $100,000, you're right, because you don't live in a cash flow market. So what you've got to do is find a market that feeds your goals. And if your goal is cash flow, you need to find a cash flow market, a cash flow oriented market. So this is one of them. This is actually the numbers from a deal that I did, a very specific property that I did. And so let's look at this through two lenses. There are two lenses that we have to look at this through. One is our numbers, our cash flow. This is what we care about. Our cash flow numbers is the amount of money that hits our pocket, okay? It's the amount of money that we could actually spend. All right? And then the other way that we're going to look through this, through the lens of this, is taxes, the way that the IRS views it. Okay, so let's take it at this. First, let's start at cash flow. So first, we've got rent. Our rent at $1,200 a month for the entire year is going to be $1,400 or $14,400. Okay, so this is positive. Then we're going to subtract from that any expenses. Okay, and these are called operational expenses, or what you'll hear referred to as OPEX. OPEX are all the expenses that are incurred by you running the property or running the business, whatever it might be. Any business has operational expenses. Those operational expenses, in this case, could be things like utilities if the tenant doesn't pay them. It could be vacancy expenses. It could be maintenance expenses, fixing a toilet or patching a roof. Okay, generally, if you're renting a house out for $1,200, your maintenance expenses, what you're going to save up for or pay on average, is going to be about $350 to $400 a month. So let's just say we're paying $400 a month. That would be negative $4,800 a year, okay, times 12 months. So this is OPEX. Okay, now we've got our debt service. Our debt service is our mortgage payment, right? A mortgage payment on $80,000 at 5% interest is going to be about $430 a month, $429 and some change. Okay, so that comes out to $5,160, negative $5,160 a year. All right, and bottom line, what that means for us is we make $4,400 or $370 a month. All right, so this is the cash flow. This is the amount of money that we get to walk around with and spend. And this is looking at it through the lens of our eyes, okay, what we care about. $4,400 and a little bit left over for a nice dinner, all right? $4,440. Now, the other way of looking at this is going to be looking at it through the lens of what the IRS cares about, okay? So now we're looking at it through the lens of taxes. Now, this is what we care about. We don't particularly care about taxes. We need to be aware of them, but this is what's most important to us. So let's look at it through that lens. Okay, let's do our income statement from that lens. So rent's not going to change. We're still going to make $1,440 or $14,400. Our operational expenses aren't going to change. Still $400 a month. So that's $4,800. Now, our debt service will change because your debt service, when you pay your mortgage is made up of two things. It's made up of principal and of interest. And so principal goes to your bank account. That's yours, right? It's not going to your quote-unquote bank account actually, but it's accessible. That's your money. It's now equity in your property. You can access that a number of different ways. One of the ways would be to sell, and you'd cash out that money. Another way would be taking out a HELOC, but it's your money. Okay, so the IRS isn't going to give you any benefits just for saving money. Okay, but they will give you benefits for the interest paid on these loans. The debt service on these loans for interest on a property like this, where the monthly mortgage payment on an $80,000 loan at 5% is $430. Interest on that is $333 a month. Principal only less than $100 a month. $96 a month goes to principal. Okay, so 333 times 12 comes out to be 3973, and that's negative. So we're losing that. So this is debt service just for interest, right? Now we have additional expenses that the IRS values. We've talked about appreciation before. This is where your property grows in value. But what we care about right now is depreciation. Depreciation is the way that we quantify the deterioration of a physical and material thing. Okay, so let's say you buy a refrigerator. That refrigerator is going to decompose over time. Or you've got a battery in your phone. That battery is going to decompose over time because it's exposed to the elements. All right, that's a law of nature. It's a law of physics. Everything is in a constant state of increasing disorder, and it's going to rot and decay. Now, what we want to know is how much does it decay per year? So a refrigerator is an appliance. Generally, appliances are depreciated over 5 years. So you've got depreciation values for components or appliances. You also have depreciation for your property. So the component depreciation, if we take our rehab and assume that all of that is appliances or components like that, there will be some that we can just write off all in the first year and make this more favorable to us. But if we just split that out over 5 years, we know that's going to be $5,000. Okay? So that's component depreciation. That's the amount that it costs us over time to have those things in our house, whether it's actually physical material or it's an appliance or it's flooring, whatever it might be. Okay, so $5,000 we write off in the first year, and then after 5 years, it's completely written off. Now the second is building depreciation. Now it's actually broken out into the building and the land. In my area, the land value is so minuscule relative to the building value that we'll just eliminate that for this purpose right now. But land value is not depreciable. You can't depreciate that over time. You can depreciate the building value. And the building value is depreciated over 27 and a half years for building value. So we take the value of the house, we've got a $100,000 house, divided by 27 and a half years, and what we get is a depreciation expense of $3,636 a year. Okay? So this is our building depreciation. So we get some benefits from the rotting and decay of our property. Now what this comes out to, if you do the math, this comes out to negative $3,009 a year. So what this illustrates is when we look at it the way that we look at it, through our own eyes, not the IRS's, we're making $370 a month, right? But because of the way that the IRS views these things, it looks to the IRS like we're losing $3,000 a year. And that's important because the IRS requires you to pay taxes based on your profits, not on how much money you make. If you're an individual, you pay taxes based on how much money you make, and they take the taxes out on the front end. If you're a business, and you don't have to have an LLC to do business. If you've got a rental, that qualifies as a business. You don't have an entity to put it under. You can put that under your own name. And if you have that business that's operating, you pay taxes on your profits, not just on what you make. So if you're negative, you're not going to pay any taxes. Okay? Now, this $3,000 negative, we can actually apply that to our other income. Okay, so this is an overview of why it is so valuable to own property, particularly cash flowing real estate investments. Because instead of paying taxes on $4,400 a year, which would come out to a little over $1,000, it looks to the IRS like you're actually losing $3,000 a year. And that is incredibly, incredibly important. And let me tell you why. Okay? I want to tell you why, because it can save you even more money. So for me, the numbers we just ran made it look like you were losing $3,000 a year, $3,009 a year. Now, at a 35% tax rate, that's about $1,030, right? So you just saved yourself that amount of money. Now, here's the sweet spot. For every property that I buy, the conditions, I have a negative of about $6,000 a year. So it looks like to the IRS, what they care about, I'm losing $6,000 a year. Now, let's say you had properties just like that. You had properties that were a negative $6,000 a year. And let's say you worked a job that made $60,000 a year. Well, instead of paying taxes on that $60,000 a year, you're paying taxes on your overall picture. So let's say you have 10 properties that are negative $6,000 a year. That's a negative ledger of $60,000. And your income, you can actually apply that to your regular earned income, your W-2 income, which means you're now not paying any taxes on all $60,000. And you can apply real estate losses against regular earned income up to $150,000. $150,000 a year. The IRS assumes that if you're making $150,000 a year or more, you're probably fine. And you can maintain those losses and use them later if they were advantageous to you. Or if you make less than $150,000, you can write off or you can load balance your income. So now, if you're making 60 on one side and 60 on the other side, you're actually walking away with $120,000 instead of walking away with something in your bank account like $80,000 or $90,000. It's incredibly powerful, incredibly powerful. And so that's one of the main benefits of taxes within real estate. It's incredibly valuable. You save 35 to 40% of your money. And I can't stress that enough. It's not about how much money you make. It's about how much money you keep. And so what you need to do is you need to start now. One really practical thing that you can do to start now to better understand the benefits available to you of taxes in real estate is just go get your pay stub. Go get your most recent pay stub and go see how much money was held out for taxes. Just for this month. Go see how much money you made, your top line, and how much money was held out for taxes. And I want you to think about that number. Think about what you could do with that money, that number, this month. If you had that money in your pocket this month, what would you be able to do? Would you be able to take the trip that you wanted? Would you be able to provide for your kids in a different way? Would you be able to spoil them on their birthday a little bit more? Would you be able to go visit family? What would you be able to do if you had that every single month? And that's what I want you to evaluate, because that is one of the distinct values of real estate, is sheltering you from the tax burden that you're under. Okay? And that's something I want to help you with. If you need guidance, I'm here to help. Let me know. All right? So I hope this has been helpful for you. Thanks for listening. If you have questions, feel free to put them in the comments or send me a message. If you want me to talk about something specific next week or in the coming weeks, let me know. And if you want to get in touch with me directly or you want to be coached, check out my website at blakeshwanet.com to learn more. Thanks again for listening. We'll see you next time.